Good day, fellow investors. Kraft Heinz stock is down, but the dividend yield is already interesting at 5.5%. If we look at when the whole Warren Buffett Kraft Heinz saga started, the stock is down 67%, so now we have to see whether it is a good dividend yield investment. It looks like one. So let's make a Kraft Heinz deep dive, discuss the business, financials, outlook, intrinsic value, forward PE, whether it is a defensive stock for recession proof or something like that, and then Buffett's perspective maybe on it, buy it or not for your portfolio. On top of the dividend, the company is also repurchasing stocks. So let's immediately dig into the business. They have this strategy. Every food company has some strategy to revive the business, but in general, these food brands companies are not doing great, and that will also be discussed later when we touch on the sector. North America is not doing great for Kraft. Sales are down. Fortunately, emerging markets are doing better. You all know these brands, but the question is now, when it comes to the business, are you still in love with these brands as maybe our parents were maybe 15, 20 years ago? When I was a kid, it was all about Philadelphia in the TV commercials. Now there are no more TV commercials, but still, Kraft has 50% of the North American and even more ketchup market. Okay, that's a strong brand for sure, and perhaps a reason why Buffett is in. However, if we look at organic net sales, those are down 2.2% for the whole company over the last quarter. Especially North America, down 4.5%. Emerging markets are positive. Global away from home also positive. But this decline leads to an organic net sales outlook, low end 2%, adjusted earnings per share, again, practically flat despite the buybacks. So when it comes to the business, the key question is the growth over for great brands? Consumer preferences are changing, private labels compete on price and on taste, likely, and the market seems to be saturated. And this is the key question when it comes to all these food stocks that we have recently analyzed, Mondelez, Nestle. Is still the brand power there, or are we as consumers switching to other things? Personally, we have switched to completely other things, which really removes a segment of the market, and then if that market grows, then you see those declines. But there are still the financials to look at. If we focus on the financials, we see that for the last decade, revenues have been flat, gross profit declining a little bit on those revenues, gross margins going down, which means highly competitive environment, difficult to keep market position at the same price. And you see here operating margins down, earnings before taxes, excluding unusual items, also from 6 billion, 4 billion, 4.5 billion there, of course, before taxes. But when you include unusual items like goodwill impairment, then net income looks bad. But in general, you can see here impairment of goodwill, huge in 2018, and then they constantly impair something. So maybe better to focus on the free cash flow because this is a non-cash cost. If we look at it from that perspective, 3 billion on the market cap of 35 billion, the forward P ratio or the adjusted P ratio is there around the 10. So if I look at net income, asset write-down costs and costs for restructuring 2.3 billion, net income 3.6 billion, the actual P ratio adjusted is 10, which is a very low P ratio, especially in this market. But there is this huge debt pile that the company has significantly lowered over the last 5 years. So 10 billion down in debt, that's 2 billion of value creation per year over 5 years, no matter how you look at it. So 2 billion here, a billion for the dividend, that's 3 billion. That's a 10% value creation situation for the company. Here you have the dividends, and then they also started repurchasing stock recently. So let's do an analysis of Kraft Heinz in our intrinsic value template and also compare it to others. The stock price now, as we are doing, is 29.27, and let's go for the input there. We have earnings of 3 per share, and let's make it easy. As it is a dividend stock, let's make it dividend per share here, and it is $1.6 per share for 5.5 yield. Now, the key question is, when it comes to the dividend, what will be the growth rate going forward? 8% is a little bit high, but let's say that buybacks, they do okay, stabilize the market, that the dividend grows 3%, the discount rate, I'm looking for a 10% return going forward, and then things improve a little bit, and the market gives it or expects from Kraft Heinz a 5% yield, which means 100 divided by 20 is a 5% yield on the dividend, and then the intrinsic value for a 10% return is 27.44, which is close to the current price. So the current, let's say, price would give you in that situation a 9% return at the current price, which is not bad. The dividend, some growth, let's say pretty fairly valued there. Let's look at scenario number 2. Let's say be a little bit more exuberant. Let's have them grow by 4%, then interest rates going down, that war is going away, a dividend yield of 4% like Mondelez has, and then the present value goes immediately to 33 and the stock is undervalued for a 10% return. If we go to margin of safety scenario, worst case scenario, zero growth, for the dividend, of course, 10% discount rate, and maybe the yield goes to a 15, then the stock goes down to 20 for a more margin of safety. And I think in that environment, there would also be buyers buying it to a private owner that can squeeze that. So that would be a margin of safety buy. What are the probabilities? Let's put 50, 25, 25. And the stock is now fairly valued for a return of around 9%. If we compare this to the market, 0.92, so 9% return on the ratio, similar to Verizon, cheaper than Mondelez, cheaper than Berkshire, similar to Archer Daniels, of course cheaper than Petrobras, but there are other risks. And maybe I made a mistake here, 116, no, terminal multiple, yes, if the dividend remains 3.3%, then it is, let's say, fairly valued, but it has to keep on delivering 7% growth and a 3% dividend. Maybe a little bit too exuberant here, but we have the AHL with a recession risk and then cheaper than other. So we have a P ratio of 10, a food, defensive or premium stock that can be discussed. If there is a recession, will you not buy the more expensive brands, go for private labels? That's also the question going forward. Buybacks are there, inflation growth, if they can increase prices, for now they cannot, and then we have the return of the yield. Did he make the mistake? Well, he is not a mere mortal like us. He first started with 8 billion preferred shares before the Kraft Heinz merger, getting him 9% per year, whatever. Then he got normal stocks after the Kraft merger, depending on what price. Then he got also the 4.5 billion in cash flows from dividends and that plus the value. So he invested 8 billion and he got about 14 billion now. Not a stellar return, but let's say this is his margin of safety return. So not a big mistake, but okay, he's getting some cash flows which he likes. So when it comes to Kraft Heinz, I don't know where the stock will go. That depends on interest rates. If required yield goes down to 4%, the stock goes up 20-30%, no worries. The dividend will likely stay there as they have some 60% margin payout on the free cash flows, which is okay. And the key question when it comes to buying Kraft Heinz is, are you happy with the dividend? That's it. If you're happy with the dividend, then it can surely be a very interesting dividend yield investment for the next years for a diversified portfolio. 5.5% yield is a good yield on the great brands. If there is weakness, then someone, likely private investor or someone else, will take out the company and implement it into their business for a good return. So there is also a margin of safety from that private buyer perspective. If we look at our quadrant, I have put here Kraft Heinz, no growth, but in line with Schwab, with Nike, with Verizon here in the quadrant. So not expensive as the market leaders, not mid-expensive, but let's say on the cheaper side on the market, so we could say fairly priced. Subscribe if you enjoyed this video. I'll see you in the next one.